Welcome to the Deep Dive. Today we're plugging into the Indian wires and cables industry, really digging into what's happening now and what's coming next.
Yeah, we're working off a pretty detailed ambit report here from early May 2025. It calls the theme An Electrified World, Beaten Down Expectations.
Right, an electrified world.
Yeah.
Sounds big.
It is. And, wires and cables might seem basic, but there's a lot going on under the surface.
So our mission today is to cut through the noise, pull out the key insights from this report, what's driving growth, who's competing with whom, the opportunities, the risks.
Exactly. We want to understand why this seemingly straightforward sector is actually attracting so much attention and quite a bit of investment, too.
Okay, let's get into it. The report kicks off with this electrified world idea and talks about a dream run for the top companies over the last 5 years.
That's right. The big players, they've really done well, gained market share, improved their ROE, that's return on equity, and they've managed to pay down debt.
Which investors obviously like.
Oh, definitely. Led to higher valuations, what they call multiple expansion, and the report suggests this isn't necessarily over.
So what keeps the momentum going? What are the drivers now?
Well, a couple of big things. First, expect more spending on power infrastructure transmission, distribution, T&D, and also power generation. Big CapEx cycles there.
Okay, infrastructure build-out. Makes sense.
Second, there's the whole renewable energy boom in India. That needs a lot of new cabling, connecting solar farms, wind projects, you name it.
Right, and it feels like exports are becoming a bigger piece of the puzzle, too.
A very big piece. Top Indian firms like KEI and Polycab are now, genuinely competitive globally. They're ranking in the top 30 worldwide.
That's impressive.
Yeah.
So a domestic boom plus growing international reach.
Exactly. And because of all this demand, both domestic and export, their factories are running flat out. Utilization is peaking.
Which leads to
Big expansion plans. The report flags around 132 billion rupees in planned capex over the next few years, FY26 to FY28.
That's a serious amount of investment. But the report also mentions the market got a bit jittery. Something about new players.
Ah, yes. UTCEM and Adani entering the space, that did cause a bit of a stir. And you saw the valuation multiples for the existing players take a hit.
What was the fear? Too much supply coming online?
That was the main concern, yeah. That a flood of new supply could dilute profitability, push down that ROE across the board. But the report sort of argues this risk might be contained if the established, organized players can keep growing their revenue at, say, 12% or more per year.
Okay, so growth can absorb some of the new capacity, and after that market correction, maybe expectations are a bit more realistic now.
That seems to be the view. Expectations got beaten down, like the report title says. So if these companies deliver, there could be upside.
And they're being strategic about how they grow, not just chasing volume.
Very strategic, focusing on the right product mix, the right sales channels, retail versus institutional, aiming for that sweet spot of maybe 15–20% growth in ROE.
Which is still strong, even if slightly below the peaks they saw before.
Right. Partly because the consumer electrical side of things for companies like Havells or Polycab isn't growing quite as fast right now.
Okay. And one more point from this section. The report seems to favor companies heavily into cables specifically. Why cables over just wires?
Good question. The thinking is the cable segment is maybe less crowded, less competitive than basic house wires. And importantly, cables offer better potential for higher margin exports.
Got it. So based on that, they have specific recommendations.
Yeah, the pecking order in the report is Polycab first, then KEI, then RR Cable, and then Havells with BUY ratings on them.
Interesting. Let's dig into that massive capacity expansion, the 132 billion. Is that companies just being bullish, or is it really needed right now?
The report suggests it's very much needed. It's less about chasing some future dream and more about reacting to demand that's actually been stronger than expected.
So they're running up against limits now.
Pretty much, yeah. Maxed out capacities are a big driver for these investments. They need the extra lines just to meet current and near-term demand.
And does the report see a risk of building too much, creating a supply glut?
They ran some numbers, a sensitivity analysis. It suggests things should stay reasonably balanced demand and supply-wise.
Okay, what are the assumptions there?
Key assumptions are that the organized players keep up that 12% overall revenue growth, and critically, that exports keep growing at around 18% a year through to FY29.
Is that 18% export growth realistic?
Well, it's basically the same pace they achieved over the last 5 years. So if they can maintain that momentum, the balance should hold.
But there are always risks. What if demand slows down?
True, a general economic slowdown is always a risk, but
Yep.
the top companies have a few levers, right?
Such as?
They can continue gaining share from the unorganized sector, that formalization trend. They can push harder on exports and just benefit from underlying domestic growth drivers.
Right. And circling back to UDTCM's entry you mentioned, the report downplays the disruption risk compared to, say, paints. Why?
Two main reasons suggested. One, setting up W&C manufacturing apparently isn't quite as capital intensive as, say, a massive paint plant. Lower barrier, maybe?
Okay.
And second, maybe the market's just got more tempered expectations this time around, not expecting UTCEN to completely upend the industry overnight, so less likely to be hugely disruptive immediately.
Got it. Let's shift gears slightly to the market structure. You mentioned the big getting bigger.
Definitely. The report shows clear data, Exhibits 4, I
Yeah.
think, that the market share of the top 3 and the top 5 companies in the organized market keeps climbing. Consolidation is happening.
How are they doing it? What's the winning strategy?
A big piece is cracking the retail market. They've really focused on getting a higher share of revenue directly from consumers and smaller contractors.
Brand building, distribution,
Exactly. Investing in the brand, making sure their products are easily available everywhere.
and the smaller players. How do they fare?
It's tougher for them. They tend to be more reliant on bigger institutional sales, often lower margin, weaker brands, less cash flow.
Which makes it hard to invest and grow.
Precisely. Harder to fund expansion, harder to manage working capital effectively. Exhibits 5 and 6 show that difference quite starkly.
Where's the bulk of the demand actually coming from these days?
The report points to two main areas driving about 60% of the growth: real estate construction, housing,
Makes sense.
and the power sector. That includes renewables, which we mentioned, but also the traditional T&D upgrades and expansion.
And any other notable growth pockets?
Yeah, data centers are mentioned as a rising opportunity. They need tons of specialized cabling, and just general T&D capex continues to be a steady driver. Exhibit 9 highlights some of this.
You mentioned working capital. Is there a big difference between the leaders and the rest?
Huge difference. Exhibit 10 shows the top players have significantly fewer working capital days. They manage their inventory and receivables much more efficiently.
And that translates to
Better cash flow. Exhibit 11 shows their pre-tax cash flow from operations as a percentage of EBITDA is way higher than the smaller guys. It's a sign of operational strength.
okay, let's zoom in on the big four mentioned. Polycab, KEI, RR Kabel, and Havells. Their specific expansion plans. First, who's building the most?
Polycab has the biggest capex number planned for FY 25-28, according to Exhibit 12. Then KEI, Havells, and RR Kabel follow. Again, mostly driven by needing more capacity.
Right. Now, their competitive advantages. What makes Polycab strong, according to the report?
Polycab's big strength are its dominant share in cables and its really deep distribution network. They consistently outperform.
And they have some kind of internal project.
Yeah, Project Spring, aiming to grow even faster than the market in their core W&C business.
Well,
But the report does also mention the tax authority investigation, which caused a temporary dip in demand. Important context.
okay, what about KEI?
KEI is also strong in cables, good export focus. Their distribution isn't quite as wide as Polycab's, though. A key thing for them is they're actively trying to reduce their EPC business, the project side, and want to become totally debt-free.
Interesting strategic shift. And RR Kabels.
RR Kabel seems very focused on brand building. They spend a lot there, relatively speaking, and they have this big push to connect with electricians directly, like through their RR Connect app.
Engaging the influencers.
Exactly. They did have some recent earnings misses, which impacted their valuation, but they've got significant cable capacity expansion coming online, and they were early movers on exports.
And finally, Havells.
Havells' strength is definitely its brand name, which is powerful across all its electrical products and its very wide distribution. They had a bottleneck in cable capacity, but the new Tumker plan is supposed to fix that.
So everyone's betting on more capacity and trying to leverage their specific strengths. Exports seem key for almost all of them now.
Absolutely. It's a major theme. They're more competitive globally now. Order books are apparently looking good internationally.
Who's leading the export charge currently?
RR Cable actually has the highest export share right now, but Polycab and KEI are pushing hard too. The report even mentions a specific opportunity in the U.S. due to tariffs on other countries' products.
Yeah, interesting dynamic. And internally, within India, they're all fighting for shelf space and installer loyalty.
Very much so. Expanding distribution, increasing that retail share we talked about, launching loyalty programs, apps for electricians. It's all about winning that last mile connection. Exhibits 24, 25, 30 touch on this.
Okay, let's revisit the new entrants in profitability. The report argues the big players can withstand the pressure because of their cash flow.
That's the core argument. Their ability to generate cash gives them a massive advantage over smaller firms who might struggle to fund growth or handle working capital swings. Exhibits 6 and 3238 show this financial strength.
And historically, have their ROEs held up during investment cycles?
Yes, exhibits 95 and 96 show that historically, their ROE has been pretty stable despite capex, partly because they were also reducing debt.
But there's a potential caveat.
Yeah, the report does note that while W&C ROE might hold up, the consumer electricals part of their business could see some margin pressure because everyone is adding capacity there. Exhibit 98.
Right. So let's talk valuation. Multiples came down, you said. Why?
Partly those FY25 earnings misses often linked to the capacity constraints they're now fixing, and partly just the sentiment shift with new entrants like UTCEM announced.
But the underlying demand story is still strong.
Seems so. Demand tailwinds are there, supply issues are getting resolved, yet the multiples are sitting below recent peaks.
So maybe an opportunity, if you believe the growth story.
That's what the report implies. It also notes that consensus growth forecasts are actually lower than what these companies have delivered historically. A reverse DCF suggests the market isn't pricing in heroic growth anymore.
And they give specific price targets.
They do. Polycab at 7,000, KER 3,883, RR Kabel 1,803, and Havells 1,755, suggesting decent upside from where they were when the report was written.
Okay. And just to hammer home the point why the preference, again, for cable-heavy companies.
Simply put, less competition in cables compared to basic wires, and better potential for profitable exports. Exhibits 86 and 87 provide some data on relative demand and utilization supporting this.
And the report breaks down how each company stacks up across different segments.
Yeah, Exhibit 79 gives a nice summary who's strong in building wires, LVMV cables, HVEHV cables, special cables, retail, institutional, exports. Covers Polycab, KEI, RR, Havells, plus a PAR and Finalex.
Useful comparison. And RR Cable's brand spending stood out.
Yes, Exhibit 81 highlights they spend the highest percentage of revenue on brand building among the core W&C players. Clear strategic choice.
Lastly, any major red flags? Risks or governance issues?
The main risks mentioned are the usual suspects: a sharp slowdown in demand, a big drop in copper prices maybe, or aggressive price wars sparked by new entrants.
And governance.
On the accounting side, the report's analysis flags the top players, Polycab, KEI, RR Kabel generally in the green zone, suggesting low concern from their perspective.
Okay, so pulling it all together, what's the big picture takeaway?
The Indian wires and cable sector looks set for more growth, no doubt. You got infrastructure spending, renewables, exports. A lot of tailwinds. But the competitive intensity is definitely heating up. Lots of new capacity coming online, plus those big new entrants. It's not going to be a walk in the park.
So the winners will likely be.
The report leans towards the established players with strong balance sheets, efficient operations, a good foothold in cables, and a smart export strategy. They seem best positioned to navigate the changes.
It's definitely a dynamic space, more complex than it might first appear. A lot to track.
All right, this has been a fantastic deep dive, really unpacked the key dynamics shaping this crucial industry. So here's a final thought for you, our listener, to chew on. With all this planned investment and the different strengths of Polycab, KEI, Kabel, Havells, and the new entrants, who do you think is really set up to dominate the Indian W&C market over the next decade? And maybe more importantly, what unforeseen curveball, a technology shift, a policy change, something else entirely could throw the whole race wide open? Definitely a space to keep a close eye on as India's electrification journey continues. Thanks for diving deep with us today.